this sell-off on Wall Street had a lot to do today with what is happening over in Europe. A lot of concerns about the sovereign credit risk that some of these banks hold. Now, Jonathan Binder is the chief investment officer at Consilium Investment Management. He sold his Argentine sovereign bonds 9 months before the country defaulted back in 2001, and he says he sees similar problems now in Europe. Jonathan, thanks so much for joining us. Tell us exactly what are the problems you see. What's going to blow up here exactly?
Well, I think it's pretty clear at this stage that Greece is going to default. They're in a recession, near depression. They're cutting spending, desperately raising taxes, but their revenues are not meeting targets. So their debt to GDP dynamics are continuing to deteriorate. And I fully expect them to throw in the towel, I would say, sometime within the next 6 months or so as they see further social chaos. And the realization, which we saw from Argentina after 1 to 2 years of desperately borrowing more money from international agencies like the IMF, eerily similar to what we've seen out of Greece over the last year and a half. And eventually they will capitulate, and there will have to be a full debt restructuring in Greece.
But Jonathan, when the situation erupted, with Greece, more than a year ago, people were saying that, look, even if it defaulted, it would not affect. There would not be a huge, massive contagion effect all around the world, particularly here in the United States. So what's different this time around? Is it that we know about the exposure more among the European banks to Greece, or what is it exactly?
Well, they're wrong. I mean, there will be absolute contagion, but really because if you look at the numbers, they simply indicate that a number of European countries are at levels of debt and forward-looking growth prospects that don't make their debt sustainable. And the cost of their debt is going up. And quite simply, by the time you add in Portugal, Ireland, and potentially Italy and Spain, nobody has enough money to bail them out with. And therefore, a number of these countries are eventually also going to have to restructure. And the burden of that pain is going to be shared across a very broad number of investors, including banks and other financial institutions and funds. But ultimately, the levels of debt and the cost of that debt are not sustainable, and they will have to restructure. What you're seeing out of policymakers today and for the last year and a half is dealing with the symptom of a problem rather than the problem itself, which is simply governments have overspent for a long period of time, assuming a very low cost of debt and assuming relatively optimistic growth rates. And clearly, globally, we are now going through a period where investors are finally getting to realize that growth is going to be a lot less than they had hoped for or expected. And obviously, the cost of debt is also going to be higher.
Hey, Jonathan, can you expand on what a Greek default is actually going to look like? I mean, I know you've been buying CDS, and that's obviously been a winning bet so far. But as far as, for example, the fledgling federal structure of Europe, how does that work? Do they throw Greece out of the European Monetary Union?
Well, funnily enough, not necessarily, although ultimately I think that will happen. I think the first step is just a full restructure. But the second problem that Greece faces is not just its unsustainable level of debt, but it is also a highly uncompetitive economy. So they don't have the ability to grow. They can't export. Their inflation is higher than the rest of Europe, and the problem is getting worse. So therefore, I see the first stage as being a restructure, and then ultimately, after the restructure and things start to deteriorate again, probably a year or two later, ultimately the Greeks will again make the decision that life outside the euro is the only way that they can get back to some kind of sustainable growth path.
Jonathan, just got 20 seconds here, but I noticed you're buying protection against France as well. Obviously, it's a totally different economy. What's the problem in France?
Well, France is, in my opinion, very similar to the United States, except worse. So the decision today by S&P to affirm their rating is a little curious to me. But political dysfunctionality, the relationship between the people and the government in terms of their expectations and demands, wrong way up, increased commitments in terms of their bills to the rest of Europe.
Got it. All right. Hey, Jonathan, thanks so much for joining us. Really appreciate it. Jonathan Binder there from Consilium Investment Management.